look, the mega caps on the left hand of the screen, all in green territory now. And Tesla has been the outperformer since this morning when it opened up in the green, up more than 7%. In fact, Tesla has been leading the electric vehicle stocks higher.
Lucid Motors shares down by almost 14%.
A loss of 64 cents a share on revenue of $26.4 million. But that's not why the stock's under pressure. Here's the reason why. The company dramatically cutting its guidance for 2022 production. For some perspective, the guidance was to build 20,000 vehicles this year. The new guidance, only building 12 to 14,000 vehicles, substantially lower than the previous guidance.
Yeah, well, people buying Lucid at $55 in November were anything but, by the way.
In this video, Tesla stock soars, Lucid stock collapses after the company discovers that production is hard, and Tesla's so-called competition admits they're completely screwed because Tesla is too talented and too far ahead. So let's get into the video. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. First order of business today, Tesla stock up about 7.5%, over $60 per share, basically going vertical. As I said in yesterday's video, given the uncertainty where Tesla stock was at that point in time, I personally wouldn't have been waiting on the sidelines, and this has made my point. Of course, it's impossible to know what will happen to a stock over the short term, and anyone who thinks otherwise is a fucking moron. It's not something that we can control, but it is possible to identify a bargain, in my opinion, and Tesla stock in the 7 or 800s or 900s or 1000s or 1100s or 1200s, I could keep going, but you get the point. In my opinion, still one of the best bargains, at least that I can find in the stock market today. Meanwhile, Lucid having a great day, up almost 10%. Wait, hang on. Oh, but then they reported earnings after the bell, and yeah, stock down 14.5% as I record this. I don't exactly know what investors were expecting, but obviously not what Lucid reported. Well, spoiler alert, here's how every quarterly earnings call for every electric vehicle startup goes for the next couple of years. Delays, reduction in production targets, needing to raise more capital, things taking more time, things being more expensive than expected, on and on and on and on and on. This is the same pain Tesla experienced 10, 15 years ago when beginning to ramp their own EV production to volume. As Elon has said 1 trillion times, prototypes are easy, production is hard. Most of the investors in these companies don't seem to know what's around the corner. If they did, they probably wouldn't be paying the insane prices they currently are for these EV stocks. In fact, one of the best calls I've ever heard on CNBS, which isn't saying a whole lot, but credit where it's due, I think this sums up my thoughts perfectly.
Yeah, well, people buying Lucid at $55 in November were anything but, by the way.
Literally couldn't have said it better myself. And before we move on to some of Tesla's other so-called competition, let's have a closer look at the lesson Lucid has learned so far about production being difficult. Over here on Bloomberg, quote, Lucid sinks after cutting production goal on commodity woes. EV startup delays upcoming SUV until the first half of 2024, so upcoming product delayed. Surprise, surprise, this will be a recurring theme from all EV startups. Lucid Group lowered its production target for 2022 to a range of 12,000 to 14,000 cars, down from a previous goal of 20,000, which is a huge drop, citing extraordinary challenges with logistics and its supply chain. Now, the truth is, we'll never really know how accurate these statements are. This is an easy way to hide behind issues you're having ramping production. Oh yeah, the supply chain shortage, that's fucking us too. Could be valid, but we're not talking about huge volumes here. So one argument, it's not that many vehicles, surely you can get the parts, no problem. The other argument is, well, if it's really low volume, maybe suppliers going, nah, fuck you guys, you've got 10,000, 15,000, now we're not gonna bother, get them somewhere else. Who knows what's happening? But here's another important thing. The luxury electric vehicle startup also came up short on its stated goal for deliveries last year. Lucid said Monday it delivered 125 of its Air sedans in the final quarter of 2021, after originally planning to ship more than 500. And for the record, I've seen a lot of photographs of the handovers of some of these vehicles. Many of them, I don't know how many, but many of them have gone to Lucid employees. I don't know how many have gone to members of the general public. It seems Lucid are beginning to find out just how difficult volume production can be. I'm just kidding, they haven't reached volume yet. They're just finding how difficult production can be. I mean, we're talking about 125 vehicles delivered. They've produced a total of 400 or so of the sedans total, more than 300 delivered to customers. I mean, in the scheme of things, we're still not even close to volume production. Now it's time to hear some of Tesla's so-called competition explain why they're completely screwed, because Tesla's too far ahead and far more talented. Now please don't share this video with any of the self-hating, mentally ill, basement-dwelling adult versions, also known collectively as Tesla Q, because this may go against their thesis that the competition is coming. After all, if the competition is literally admitting, hey, we can't do what they're doing, they're better than us, they have the technology, the talent, shouldn't that give you pause? The very companies you're claiming will catch up to Tesla are like, yeah, we got a bit of a problem, guys, and we're happy to admit it publicly. Stellantis admits building cost of EVs is 40 to 50% more than ICE vehicles. For those unfamiliar, Stellantis is a result of a 2021 merger between Fiat Chrysler and PSA Group. There's a ton of brands within this amalgamation, including Alfa Romeo, Chrysler, Dodge, Fiat, Jeep, Ram, and plenty more. This is one of the world's largest automotive manufacturers. Quote, during Stellantis' 2021 earnings call, the CEO admitted that building EVs is a costly endeavor for the company. He described the cost of electrification as the gorilla in the room. As per the automaker's numbers, building an EV cost them 40 to 50% more than an internal combustion engine vehicle. This is a massive statement, but it gets even more interesting. However, what is shocking is that Stellantis believes it is 30% more efficient than other traditional automakers in the electric vehicle space. Here's a question. If your goal as one of the world's largest automotive manufacturers is to make compelling electric vehicles that consumers want to purchase that are also highly profitable, as Tesla is doing today. Huge wait times, 30% gross margin on automotive, 2 to 3 times above industry average numbers. I mean, they're absolutely insane. If your goal is to catch up to Tesla, but you're starting with costs 40 to 50% higher, how do you get there without going bankrupt? This is something to think about. How do you offer something competitive on price? You can't make a 30% margin. You're making negative margins. You're going to have to lose money just selling this vehicle at a comparable price to a comparable Tesla. These are the facts. Eventually, if you get to millions of vehicles per year, you can drive your costs down totally. But getting to that point, selling millions of electric vehicles per year, has to happen on a planet in which Tesla is selling 5, 10, 20 million electric vehicles per year. They benefit even more from economies of scale, their costs are even lower, you never catch up to this company. This is a serious problem. I don't think a lot of people seem to understand this. At the same time, these companies, legacy automotive manufacturers, are desperately trying to sell vehicles in a comparable price range to a Tesla and losing colossal amounts of money on every single vehicle sold. Their ICE vehicle sales will be collapsing, the cost for them to produce ICE vehicles will be increasing, their ICE vehicle margins will be decreasing because their costs are going up. They're experiencing economies of scale in reverse. The lower their scale, the more their parts and processes cost per vehicle sold, the higher their costs go. It's an absolute train wreck. They're going to be copying it from both directions at the same time. This is a financial catastrophe waiting to happen for every legacy automotive manufacturer. And it's not just Stellantis openly admitting that Tesla is so far ahead it's a joke. Here's what Ford CEO Jim Farley recently had to say. And just a warning, make sure you're sitting down for this. Quote, Ford CEO just said the automaker has too many people, and just jumping in here, this is fair, it's accurate, but it's amazing to see CEO of Ford Jim Farley actually have the balls to say this out loud, and lacks the talent to execute its shift to electric cars. Jim Farley once again is correct, and I'm amazed to see him saying this out loud. Truth be told, this is an extremely bullish signal for the company. Recognizing reality is the first step. Quote, Ford CEO Jim Farley is hinting at major overhauls for the company's workforce. Finding the talent for the shift to electric cars is top of mind for the entire auto industry. Ford CEO Jim Farley is hinting at major restructuring of the company's workforce as the American automaker puts more emphasis on its electric vehicle business. Farley said at Wolfe Research Auto Conference Wednesday that Ford's two powertrain divisions, one making engines for gas-powered cars and the other, batteries for electrics, are under-earning. They're held back by a bloated workforce, over-complexity between the two divisions, and excessive investment, he said. Quote, we have too many people, we have too much investment, we have too much complexity, Farley said. All true points, all fair, and again, amazing to hear them being said out loud. Quote, there's a lot of focus on the digital electric growth opportunity, but we believe we have lots of room in our ICE business for better quality, lower structural costs, and a radical reduction in complexity. As we know, the ICE business will be extinct in just a matter of years. Farley, however, is making some fair points. If you're going to be selling ICE vehicles for a few more years to come, you may as well be driving down the cost of those as much as you possibly can, especially since consumers are going to stop buying them and your costs are going to go up anyway. The Ford chief executive said the company will need more, quote, restructuring talent as it transitions its business. Ford is spending $30 billion on electric vehicles through 2025 as a part of a broader remaking of its business. That move will require a different skill set from much of the company's workforce. Super important point. From those developing vehicles to those managing the shift, Farley said, referencing a series of epiphanies he's had as CEO. AKA, Jim Farley has woken the f*** up and realized what's going on, which is far more than can be said for many CEOs of many legacy automotive manufacturers. Ford's challenge is indicative of an industry-wide phenomenon as more companies whittle down their internal combustion powered offerings. Car companies that evolved to build gas cars essentially employed too many of the wrong types of engineers, super important point, and technical workers, and need to replace them with the digitally focused workers who can pump out battery electric vehicles. Quote, the ICE talent and the battery electric vehicle talent are different, Farley said. Quote, you can't ask ICE people to do certain things. It takes too long. Again, this is a very important point. I've said this a million times, legacy automotive manufacturers, most of the existing talent is not really going to be useful in an EV world. In addition to the technical talent needed to develop electric vehicles, Farley said the company is also looking at changes to its go-to-market strategy for electric vehicles, which he says will need to include more online sales. Again, this is huge because dealerships, if you don't know the way the business model works today, you've got car dealerships in between the producer of the vehicles, aka Ford, and the consumers. The dealerships mark these things up. They make a ton of money servicing the vehicles. Ford's dealerships are everywhere. How do you think the dealerships will feel when Ford's like, yeah, you know what? Customers can just buy these vehicles online and know what price it's going to be, and you guys are completely useless and irrelevant now. Bye. Not going to be pretty. Back to the article, which he says will need to include more online sales and require less inventory than gas-powered cars. He pointed specifically to Tesla's no dealer model as a guidepost for squeezing more profit out of each vehicle. Quote, it requires new talent on the customer experience, Farley said of selling EVs. He said electric vehicle customers should have a less complex pricing and shopping experience. In other words, they're just going to copy Tesla. Fixed price, order online, done. It saves time, he said, and we want those customers to be fully digital and to have no inventory in the system. So not only do we have Stellantis admitting their cost to produce EVs are 40 to 50% above an ICE vehicle, absolutely insane. They'll never make money selling these things. We have Ford CEO admitting we don't have the talent, we don't have the engineers, plus we're going to have to get rid of most of the jobs because these people won't be useful for us producing electric vehicles. Oh, and by the way, we also have to get the f*** rid of all of our car dealerships. I really admire Farley for having the balls to say out loud what he knows to be true. There are very few other automotive CEOs out there willing to be so candid, or they're just so f***ing dumb they don't even realize the situation they're in. But there is one other automotive CEO willing to state the facts. Enter Herbert D's nuts. From late last year on Bloomberg, VW CEO tells German workers Tesla factory will threaten jobs. CEO expects Tesla's German site to boast superior productivity, aka Tesla is better than us, nicer, they're more efficient, just better. This is the quote I want to focus on. Tesla is swiftly improving quality and looks set to achieve a production time of just 10 hours per car at its Grünheide plant, D said Thursday in a prepared speech at a staff meeting in Wolfsburg. VW's main electric car factory needs more than 30 hours per vehicle. So here, Herbert Diess admitting out loud it's taken VW 3 times as long to make an electric vehicle versus Tesla, and VW's goal is to get that down to 20 hours. Not 10 like Tesla, but 20. So they're aiming to be half as efficient, half as productive. Again, we go back to Stellantis, they're talking about 40 to 50% higher EV costs, and now we're seeing VW, it's taken them 3 times as long to produce an equivalent vehicle, and their goal is to get to just twice as long. I mean, kind of embarrassing. So just to recap, new EV startup Lucid, starting just barely to discover that production is slightly more difficult than producing a prototype, just slightly. And as I predict, this will be a recurring theme. All EV startups, it's the same shit. Quarterly earnings, oh, we're delaying this product. We're reducing this production target. We're having difficulty finding certain parts. We have quality issues. Blah, 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 blah. They're all at the base of the mountain, beginning to climb Mount Everest in their underwear without any food or water. I wish them the best of luck, but it is going to be a difficult journey. And on the other end of the spectrum, from electric vehicle startups to legacy automotive attempting to produce EVs and eventually run down Tesla, we have admissions from a few of the world's largest automotive manufacturers, CEOs saying out loud, you know what, we don't have the talent, we don't have the engineers, we're going to have to massively cut back jobs, we're going to have to spend a huge amount of money. Tesla's making vehicles more efficiently, cheaper and faster than we are. AKA, we're seriously fucked. As I've said previously, I actually think one of the most bullish signals from a legacy automotive manufacturer in terms of their likelihood of surviving the decade without going bankrupt or being acquired is to 1, recognize the truth, which is a very difficult step in the first place, and 2, actually speak it out loud. I know it may seem a little bit ridiculous to assign so much weight to such a signal, can't mean that much just because they admit that they're fucked. But if I were a betting man, I'd be willing to say the probability of a company surviving will be in relatively close proportion to how early they recognize and then publicly state how far ahead Tesla is and how much work they have to do to even try to catch up. And the more gaslighting of the public, the more accepting credit for pioneering or leading the way with the EV transition when it's not true, the more moronic commentary out loud about, oh, we don't know about battery, but people still might buy gas vehicles in 2035, and what about hydrogen? The more fucked you know this company is. Let me know in the comments below, which of the legacy automotive manufacturers do you think are most likely to make it and least likely? And just a quick heads up to my Patreon supporters, new Q&A should be dropping pretty soon, so keep an eye out for that. And if you'd like to support the channel over on Patreon and gain access to a ton of exclusive content, including over 100 Q&As, check the link in the pinned comment, and I'll see you over there. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment theme merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.